Morning, everyone, and welcome to Mindspeak. It's a pleasure to have you all here again, and it's a pleasure to be hosting karimsadek today. I know Karim's got to catch a flight to Cairo later on in the afternoon, so we thought we'd start on time. If I can just briefly do an introduction about Citadel Capital in case anyone doesn't know everything about them. Leading private equity firm in the Middle East and North Africa, ranked by Private Equity International as the largest firm on the continent, focuses on building regional platform investments throughout the region in select industries through acquisitions, turnarounds, greenfields, executed via opportunity-specific funds. Citadel Capital has 17 OSFs, opportunity-specific funds, now control platform companies with investments of more than $8.3 billion in 14 industries: mining, cement, transportation, food, energy. Since 2004, firm has returned more than $2.4 billion in cash to investors, more than any other private equity firm in the region. So they're pretty big. And Karim, who I've known for some time, I think about 2 years, and before I tell you about Karim, my favorite moments with him are we have breakfast once every so often. And he regales me with these wonderful tales, and we end up having breakfast for like a couple of hours. And one day he was describing to me being in Sudan and telling me about, how you're conducting business at the frontier. And they were in some place which was a little bit hairy, and there's only one pilot available to fly him out of there. And Karim says, as the pilot approached, he could smell his breath. And it was a choice between flying with a drunken Ukrainian or staying wherever he was. And he made the decision to fly. So karimsadek is a managing director of Citadel Capital, the leading private equity firm in the Middle East and North Africa. Citadel was established in 2004. As I said, 8.3 billion invested across all these different industries. Prior to joining Citadel, Karim was managing director of the Arab investment company, ABIC, one of the largest private equity firms in Egypt. During his period at ABIC, Mr. Sadek returned a substantial part of the firm's total investments, valued at over Egyptian pounds 500 million, to ABIC shareholders in the form of dividends and share buybacks. Karim holds a master's in international securities, investment and banking from the Business School for Financial Markets at the University of Reading in the United Kingdom, has extensive experience in corporate banking and credit risk assessment through his work both at the Commercial International Bank and at the Arab Bank. And Karim, I'm very grateful to have you here today.
Thank you.
And the floor is yours. Thank you.
Good morning, everyone. It's a pleasure to meet all of you, and I'm sure I'm even more honored. It's Saturday morning, so I'm really glad that so many of you could make it. Thanks, Ali, for this introduction. I'll just start with a quick presentation, and then we have a very short video about something that I think is relevant to all of you here specifically, probably more than the presentation. Just a couple of comments on Ali. We've gone through a lot these past few years as Citadel Capital, both on the business side and how our businesses have been dealing with and reacting to changes in North Africa, obviously on the political front. So there will be, I'm sure, some discussion on that, but that has been quite a learning experience, and as they say, what doesn't kill you make you stronger. So we'll get to that at a later stage. So just quickly on Citadel Capital, as Ali explained, we basically, just in simple English, what we do is we manage our own money and third-party money, be it debt or equity, into specific investments that have a couple of themes that have always guided us in our philosophy. Just go through the numbers quickly. So $9.5 billion is really the investments, the cost of the investments under that are managed by us. Of that, $940 million are our own prop balance sheet funds, 15 industries, and 19 opportunity-specific funds. Just to explain that last one quickly, we basically try to combine or consolidate as many investments as possible that can fall under one industry into what we call an opportunity-specific fund. Sometimes the business itself doesn't allow it, or circumstances of the acquisition, but that's always our intention, is to basically form industry-specific holding companies, which are called here opportunity-specific funds. It helps a lot when you want to get able management that are normally quite costly, to be able to leverage a number of these investments by using the same management team. So basically that's the breakdown of the 9.4. We have around $4.3 billion of committed and dispersed equity. That's ours and third party, obviously. Committed debt is $5.15 billion. Obviously, these two numbers have a huge single component in our latest investment that we've managed to close, which is the Egyptian refinery company. There is a small section on that in the presentation. And as you can see, the $940 million of our own balance sheet money. Footprint and growth drivers. I think it's relevant to two things, that the two main driving themes in our investment philosophy. Number one is that we believe we live in a part of the world where you'd rather not invest in higher end products and services. Most of the markets we're operating in do not have the depth and the history to have a sustainable higher end consumer base. So just in simple words, you will not find Citadel coming in doing upper end real estate investments. We'd rather do investments that either into services or products that, even if they have lower margin, have a much bigger market and sustainable, because that market is going to always to be there, and it's a function of you being efficient in your production and service providing. Targeting upper end consumers, I think, is a very dangerous proposition, and we've seen it ourselves. When things get a little bit critical, you won't find that consumer around. So that's the first driving force. We like to invest in whether it's directly or indirectly, but products and services that end up being consumed and delivered to a bigger number of consumers. The second driving force or philosophy that we've always had, we have quite a big exposure to energy, and we're very much convinced that the age of cheap energy is gone forever. And it's not a matter of just demand. So it's not a matter of the China growth rates or Indian increase in imports of oil. That's not. It is a factor, but it's not the major factor. We believe the major factor is on the supply side. There are simply, especially on the liquid hydrocarbons, i.e. crude oil, there has been very little of new discoveries in the past 10, 15 years. And when there has been, they're also extremely expensive and technically complicated. Case in point, Brazil offshore, Atlantic, the oil sands in Canada, and now we're hearing about a run to explore for oil in the Arctic. So you can imagine that the break-even cost for that barrel of crude oil produced in the Arctic is definitely not going to be anywhere near $20 a barrel. So with that in mind, we try to take that into consideration when we're investing. So we believe that you'll always be more efficient if you're operating assets that are much more efficient on fuel consumption. So hence our investment in RVR, and hence our investment in the river transport in Egypt. Obviously, on the first point, on the markets, I mean, you all know this blindly now about the potential of Africa on the consumer side. So there's no need to spend a lot of time on that. I just want to say that on that specific issue, I've personally been involved in covering sub-Saharan Africa with Citadel since 2009. And I can definitely vouch that there has been a substantial increase in interest by the non-traditional players in the continent, so by endowment funds, by various institutional investors, especially in Western Europe and North America. But I'll caution that a little bit. I think a lot of that is interest when it comes to writing a check for investments, for investing in sub-Saharan Africa. Outside the resource play, so outside mining and oil, it's still lacking substantially. That's very relevant to note, because I think there are a lot of opportunities, but there is also a dire real interest. I mean, there is an interest to listen, but real interest as in writing checks for investments in sub-Saharan Africa outside specific sectors from Western non-DFI, non-development finance institutions investors is still lagging substantially. Basically, this is just a quick map of our core investment countries. Just a few examples on the themes that we are discussing. The resource play here is really a little bit misleading. That's just one of three businesses that ASCOM has. The rest is really query management and stuff that gets into industrial applications like cement and the like. So as you can see, most of our investments, as I said, are really targeting a much bigger, as big as possible, a consumer base, whether directly or indirectly. And I'm sure also these numbers are familiar with everyone. I mean, irrespective of what the true number is, and I have some concerns about how the gap on infrastructure is calculated, but we all are very clear that this continent lacks a lot on infrastructure. The most relevant two areas where it's lacking infrastructure, and I'm sure some of you are within industry in Kenya, is power and transportation, which makes Kenyan products extremely uncompetitive outside Kenya, or at least outside East Africa. The one caution I'd put on these numbers, we'll obviously have to quote a number, is that when you're calculating a gap, you have what you have on available, that's easy to calculate, but then where you should be, this is where I'd skew that a little bit. So conceptually, of course, we have a big gap, but sometimes these numbers are driven by white elephant projects that have no reality, cannot possibly have any economic viable return. So if you're talking, I've attended a conference in Dar es Salaam where there was a presentation about the coming 10 or 15 years wish lists of governments on the eastern half of the continent. So not East Africa, but the eastern half of the continent. And we're talking about $25 billion of standard gauge railway. Obviously, the funny part is the consultant presenting these numbers was basically showing that the cumulative revenue of all these new railways would be $1 billion revenue, okay, not profit. So as you can see, we need to be cautious a little bit how we calculate the gap. I mean, that's a number of our investments obviously include very close working relationship with governments because of the formats under which these investments are done. So in the case of Kenya, Uganda, you have Rift Valley Railways, which is a PPP really. When you're getting into PPPs with governments, a lot of investors underestimate the impact of previous bad experiences that these host governments have had in various sectors, and sometimes also underestimate sensitivities of local host governments to perceived private equity as the Western example of private equity, asset stripping, very highly leveraged, all that stuff that makes Michael Douglas not one of my fans.